Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about QHD PORT interim report. QHD PORT Co., Limited offers a diverse range of businesses and services, including integrated port services, stevedoring, stacking, warehousing, transportation, logistics services, ancillary port services, plus tugging, plus tallying, plus transshipping, plus shipping agency services, value-added services, plus towing and coal blending, plus tariff-free warehouse and export supervisory, warehouse services, plus loading and unloading, plus port investment, plus international trade services, leasing and repair of harbor facilities, equipment and machineries, power and electrical engineering services, labor dispatch services. The stock price surge of QHD PORT Co., Limited, QHD PORT Co., Limited, HKG 3369, has experienced a significant 34% total shareholder return, TSR, and a 32.64% stock price increase over the past year. Several key factors have contributed to this appreciation, including robust financial and operational performance, substantial institutional investments, enhanced operational efficiency and expansion plans, commitment to sustainability, and governance improvements. The company's strong financials, with a 3.08% increase in total throughput and a 20.75% rise in container volume, have been complemented by significant institutional investments from Great Wall Life Insurance Co., Limited, and Hubei Port Group Co., Limited. QHD Port's focus on boosting cargo handling capacity, expanding its global footprint, and reducing carbon emissions has also attracted investors focused on environmental, social, and governance (ESG) factors. The company's commitment to sustainability, including a 20% reduction in carbon emissions and 100% recycling of operational waste by 2025, is supported by investments in green technology. Governance improvements, such as the abolition of the Supervisory Committee and amendments to governance policies, have also enhanced corporate governance and operational efficiency. These collective positive developments have likely contributed to the sustained increase in QHD Port's stock price over the past year. The primary drivers of revenue growth or decline in the company's financial performance can be summarized as follows. Revenue growth is primarily driven by the increase in handling services such as container handling, plus 20.75%, oil and liquefied chemicals handling, plus 10.13%, and coal handling services, plus 3.92%. Additionally, a single customer accounted for 10% of total revenue, indicating significant growth from this segment. On the other hand, revenue decline is primarily attributed to the decrease in ancillary port services and value-added services, minus 7.84%, and metal ore revenue. The decline in port handling fees and service, in relation to metal ore and relevant products, also contributed to the overall decline in revenue. Net income and profit margins. A year of change, the net income of a company underwent significant fluctuations over the past year, with both increases and decreases observed. The most notable increase was 6,187,133.32 due to non-recurring profit and loss items. However, this was offset by a decrease of RMB 55,042,605.14, minus 7.4%, in the first half of 2025 compared to 2024. Profit margins also experienced changes, with gross profit margin increasing by 1.48 percentage points year-on-year. Conversely, operating profit margin decreased from 35.8% to 35.3%. The net profit margin increased from 29.9% to 30.4%, while the operating profit margin decreased by 6.1 percentage points, minus 12.9%, in the first half of 2025 compared to 2024. The overall year-over-year increase in net income was 1.71%, with a gross profit increase of 3.37%. The significant increase in net income due to tax concessions, RMB 1,415,708,040, also contributed to the changes observed. The company's financial performance indicates a consistent generation of positive operating cash flow. This is evident from multiple sources throughout the report, including net cash flows generated from operating activities, which show a significant increase in the current period compared to the previous year. The majority of pages confirm that the company is generating positive operating cash flow, with only minor fluctuations and decreases noted. Overall, this suggests a stable financial position for the company. The company's debt level and interest expenses have undergone significant changes over the past year. In terms of debt level, while there are mixed signals, the overall trend suggests a decrease in net debts by 76% from RMB 424,388,556.55 to RMB 100,291,814.42. However, unsecured borrowings and short-term borrowings increased significantly, indicating potential liquidity concerns. Regarding interest expenses, the company has experienced contrasting trends. On one hand, interest expense decreased by 33.9% in 2025 compared to 2024. On the other hand, total interest expenses incurred on lease liabilities increased from RMB 0 in 2024 to RMB 44,562,766.08 in 2025, indicating a substantial increase. Overall, while there are some positive signs of debt reduction and lower interest expenses, the company's financial situation remains complex and requires careful analysis. Management is emphasizing cost reduction and expense-saving measures to improve financial performance. Additionally, they aim to balance risks and returns through careful risk management, with a focus on market risk, particularly interest rate risk. This suggests a cautious approach to growth while maintaining stability. The company's financial summary reveals that it has indeed paid dividends in the past year. Specifically, a cash dividend of RMB 474,930,020 was paid to its common shareholders. This indicates that the company has distributed a portion of its profits to its investors through this dividend payment. Concerns about inventory buildup or supply chain disruption exist. The financial summary reveals several indicators of potential inventory buildup and supply chain disruption. Notably, there is a significant increase in accounts receivable from related parties, page 147, and an increase in provision for bad debts, suggesting delayed payments or cash flow issues. Furthermore, the due from joint ventures and associates account has seen a substantial rise, page 148, which may indicate potential inventory buildup. Additionally, the due to other related parties account has also increased significantly, page 152. Hinting at possible supply chain or inventory management problems. These findings suggest that there are legitimate concerns about inventory buildup or supply chain disruption in the company's operations. That concludes the financial summary for QHD PORT. Feel free to comment below, and I will be happy to answer them when possible.